Morning, everyone. This is Barry Knapp, Ironsides Macroeconomics. It's Monday morning, March 1st. March is coming in like a lamb out here in beautiful Vail, Colorado. The sky looks like it does in the screen behind me today. This week's note was titled Fiscal Dominance Rate Regime. We released it on Saturday, February 27th. We are recording both a podcast and a YouTube video. The YouTube video link will be on that podcast email, and you can find us under Ironsides Macroeconomics. The first section of our note was titled A New Paradigm. The high velocity move that we had in real interest rates or TIPS yields over the last 2.5 weeks was quite different than some of the other similar moves we've had in the past. It wasn't driven by growth expectations, as Chairman Powell asserted during his congressional testimonies last week. Although the growth outlook clearly is improving, it wasn't driven by expectations of an increase or decrease, in this case, of the stock of Fed purchases or the flow of Fed purchases. Instead, this was really driven by supply. And this is a very significant regime change. There's been no clear examples of this in the recent past, where massive increases in government supply has been a driving force in pushing interest rates higher. And we do think it could have profound implications for correlations, the correlation between stocks and bonds, for example, some of the other correlations that traders rely on, like real interest rates and gold prices. We think a lot of those things could start to change as we move into a different rate regime that clearly we believe will be with us for years to come, given the debt that's going to be left over from all of this government spending. And just to create some perspective on this, it's likely now, X the minimum wage, that the Biden rescue plan will get close to that $1.9 trillion. That will make all-in government spending since the pandemic began of $5.3 trillion. That's against a paltry, tongue-in-cheek, obviously, $2.8 trillion in Fed purchases, $2 trillion in treasuries, and $800 billion in mortgage-backed securities. So the fiscal response is swamping the monetary policy response. And as we know, policy officials are good at adding stimulus, but not so good at removing that stimulus. This will be incredibly true with respect to fiscal spending because of the debt that it's going to leave behind. Now, that all sounds particularly bearish, but remember, before we get to an inflation stage, we need to have a reflation stage. And the reflation stage is powerful and positive for stocks. It is an environment where you would expect equities and rates to be rising simultaneously, except at those points when the velocity of the move becomes so great that it just creates a risk-off episode. And that's what we had last week. 3% drawdown is not a compelling entry point, but it's certainly not a reason to cut risk in your reflation-related trades. And so we recommend definitely sticking with those. Now, in the next section of the note, which we titled Choking on Supply, we really did describe these different rate regimes prior to the global financial crisis. A simplified way of thinking about the interest rate on 10-year treasuries or longer duration treasuries was to think about the inflation component and a market implied growth component. That market implied growth component was real rates. I fully recognize I'm skipping term premiums here. It's a little more complicated topic that we'll save for another day. But it really was, as growth expectations improved or deteriorated, that's what pushed real rates around. After the global financial crisis, the direction and level of real rates became all about Fed policy expectations. For anyone who was doubting that, the massive move in real rates during the taper tantrum in 2013, when Fed Chair Bernanke first talked about ending the asset purchases, brought that home or those chickens home to roost. And in 2018, we had two real rate shocks as the Fed was contracting their balance sheet. One in January that led to Volkswagen in February, another in September that led to the QT crash in the fourth quarter of 2018. We are into a new rate regime. real rates started to move after the Georgia Senate elections. That move got exacerbated. It was obviously not as big as this one, 17 basis points total. Got exacerbated by a couple of Fed regional presidents talking about tapering asset purchases later in the year. Fed officials were able to stop that move through verbal intervention from the leadership, Chair Powell, Vice Chair Clarida, for example. This move did not start with any discussion of Fed policy changes. It began with an expectation that we were going to get close to 1.9 trillion in the Biden rescue plan. And then there was going to be the Build Back Better plan coming right after it. So we are in a new fiscal rate regime, and that truly was the catalyst. And you could see it when you break down the market. We'll share our screen here, but it's also available for the podcasters. You should be able to see the chart that I sent on the email. See if I can get it to share here. So as you see on this chart, the blue bars is the difference between a 2-year and 30-year real rate. And that really started to move right as the Georgia Senate elections took off and moved to a completely different level. It had been rising somewhat ahead of that as the market was beginning to expect that election outcome. But nonetheless, this is a very different rate regime than what existed prior to that. So that's it for that chart. But it really is a different rate regime. The back end of the market is being pushed by this. Now, will there be a Fed response like there was in Australia last night, where the Australian Central Bank, Royal Bank of Australia, stepped up their purchases of QE or QE-related purchases? We think probably not. We do think at the March meeting, the Fed is going to take the steps to extend the supplementary leverage ratio. Chairman Powell got a lot of questions about that. That could improve the functioning of the Treasury market. This is an exemption for big banks for Treasury securities or cash, given the amount of cash that's going to be flooding the system in the coming weeks and months. That would be a good step. We doubt that this has reached the level where the Fed would want to engage in another Operation Twist. The average duration of their purchases is 6 years. This is part of our justification for looking at back-end real rates relative to shorter-term real rates, because the Fed is operating primarily in the front end of the market. They could double that to 12 years like they did during Operation Twist back in 2011 and 12. We think that we'd probably have to see a more significant move in rates for them to rise to that level where the Fed would want to shift their purchases. So that's it on that. We're in a new rate regime. This is going to have significant, profound implications over time. It's a real warning shot that these MMT ideas are, I'll try not to be pejorative here, not very good. So the next section of the note was called the mandate. And we've heard a lot of talking points from Fed officials, Chairman Powell, for example, about the 10 million unemployed, and we can't do anything to withdraw liquidity until we resolve that 10 million unemployed. Now, back in the last business cycle, first Fed Chairman Yellen, and then, or Chairperson Yellen, and then later Fed Chair Powell gave speeches about all the additional methods or indicators of labor market slack. And that was their justification for not tightening policy, even as the unemployment rate fell towards what they believed at that time was full employment. So back at BlackRock, when I was there, they had a Yellen labor market spider chart. The Atlanta Fed picked up on a similar type of chart. Then when I was at Guggenheim, we created a Powell labor market slack index. So we decided to put the whole thing back together. We came up with 18 labor market indicators of slack: the U3 unemployment rate, U6, underemployment rate, short-term unemployment, long-term unemployment, labor force participation rate, including for prime age women, which has been one of the sources of concern for policymakers, employment to population ratios, job openings, quits, layoffs, so on and so forth. And the bottom line here is we just don't have that much labor market slack. Just to give you some numbers on all that, our measure, the way we did it was we took the long-term range and looked at that average and said, where are we relative to that average for each of these 18 indicators, and then came up with a total aggregate. We're at 31.9% of labor market slack. In October, before a little bit of a backup in the labor market, we were at 30.6%. A year ago, and January of 20, we were at 28.3%. March of 19 was the tightest point the labor market got last business cycle. That's with a multi-decade low in the unemployment rate, and that was 27.9%. The 2009 peak was 55%. The 2020 peak was 60%. So we reversed that far more quickly than we did last cycle. We're at levels it took us until 2016 to reach, so 7 years after the expansion. And just to give you some more perspective on that, because we could see people pushing back and saying, how can we have this little labor market slack with 10 million unemployed? The female prime age participation rate is 74.8%. It was 76.8% a year ago. A 2% drop is a lot of people, and clearly not a plus. But the 2009 to 2019 average participation rate for prime age females, that's 25 to 54, was 74.9%. So we're right on that average. We think that'll come back quickly as the lockdowns end and we finally get teachers back in the classroom and all that flexibility. So the bottom line here is that slack could disappear really quickly, and Fed officials relying on that as a reason to continue to add liquidity is carries inflation risk. And this is what we've been talking about, pretty much all year long. A couple of other final notes. We got some very good news on the second of our 3 tailwinds for 2021. Remember, our tailwinds are a global manufacturing recovery from not just the pandemic, but also the trade war. The second one is a CapEx recovery from the business cycle, business confidence shock that it took in the trade war and the pandemic. And last week, we got very good news on that. Our Fed Regional Manufacturing Survey indicator of capital spending plans is improving pretty rapidly. In February, the January durables report shows very strong momentum for core capital goods orders or non-defense ex-aircraft orders. And even in the fourth quarter GDP, we saw an upward revision to intellectual property products. That's something we had noted in our bottoms-up work of the S&P 500 about how strong R&D spending came back. So that second tailwind, we think, is going to come increasingly into focus in the coming months. It is a little bit more US specific than the rest of the world, and could be a real long-term driver of strong profit margins and productivity at the corporate sector level. The labor market data coming this week, we don't think will be quite as good of news. It still looks like the extension of those unemployment benefits, which are about to get extended again, has slowed the recovery in the labor market. Continuing claims, which had fallen sharply down to 13.7 million for all programs, is at 16. It's not coming off. And it's because of these pandemic-related programs and the generous unemployment benefits, the extra $300 a week, which is about to go to $400, and the recalcitrance of teachers' unions and the like, and some of the lockdowns that are lingering, restrictions on restaurants and all. So that stuff should start to clear up in coming months, and we'll get some stronger labor market reports. But we see more downside risk than upside risk going into Friday's payroll report. So that's it for me. You can find us on at IronsidesMacro.substack.com if you wish to be a subscriber to our marquee weekly research product, which is where you get all the high quality charts and tables and specific recommendations. This is Barry Knapp, Ironsides Macro. Have a good week, everyone.